In today's world of e-commerce, where every click counts and every conversation is important, understanding your financial metrics is having a compass in a vast ocean. As an accountant specializing in e-commerce businesses, I've witnessed firsthand the transformative power of insightful financial analysis. Today, I'll navigate through the essential financial metrics every e-commerce store owner should know, empowering you to steer your business towards success. My name is Jacob Curtis. I'm a CPA, a Certified Profit First Professional, and a business coach. I started Curtis Accounting Solutions to remove the stress of doing the bookkeeping, payroll, and taxes, and to provide practical business advice that helps e-commerce stores piece together financial freedom. I'd love to hear your thoughts and questions on today's episode, so please leave a comment below, and remember to like, share, follow, and subscribe. The first metric is revenue. Revenue is the total income generated from sales, less any returns, discounts, and allowances. While it provides a snapshot of your sales performance, it's essential to dive deeper into your revenue streams, such as product categories and customer segments and sales channels, to really identify areas of opportunity and optimization. Calculating revenue for an e-commerce business involves just summing up all the income generated from sales within a specific period and then subtracting out those returns, discounts, and allowances. So here we are with our example. Over the course of a month, you sold 100 pairs of sneakers at $50, 50 pairs of boots at $80 each, and 75 pairs of sandals at $30 each. To calculate that each month, you just need to do the following calculation. Right? We've got that up on the screen. You take your quantity of sneakers sold times their price, plus the quantity of boots sold times their price, and so on and so forth. Pretty straightforward. And after we plug our numbers into the example, the total revenue for the store for the month would be $11,250. This figure represents the total income generated from sales after accounting for returns and discounts. It provides a snapshot of your store's top-line performance for the specified period. The next one is the average order value, or AOV, and this measures the average amount spent by customers in a single transaction, also called your average cart size. Increasing your AOV is a strategic lever for really driving revenue growth without necessarily acquiring more customers. Tactics like upselling and cross-selling and bundling can help boost your AOV and enhance your store's profitability. To calculate this, you need to find out the total revenue generated and then divide that by the number of orders. Well, using our same example as before, let's assume that the same data, 100 pairs of sneakers at $50 each, 50 boots at $80 each, and 75 pairs of sandals at $30 each. We know that revenue is going to be $11,250, so now we just need to figure out what the total orders are. And we have that there, quantities added together. Added those all up, we get 225 orders for the month. We do that by simply taking our total revenue divided by the total orders, and after plugging in those numbers, the average order value for your e-commerce store would be $50. This means that on average, each order placed in your store is worth $50. Understanding your AOV can really help you make informed decisions regarding pricing and strategies and promotions and upselling techniques to increase the value of each transaction. The next one, number 3, is the customer acquisition cost, or CAC for short. And CAC quantifies the resources expended to acquire a new customer. It encompasses marketing expenses, sales commissions, and other associated costs. Balancing your CAC with customer lifetime value, or LTV, is crucial for sustainable growth. Aim to optimize your marketing channels and improve your customer retention to achieve a favorable CAC to LTV ratio, or customer acquisition cost to lifetime value ratio. So let's go ahead and calculate this for our example of selling shoes. And so we're going to assume that you've spent $2,000 on marketing efforts in the given month. That's the accumulation of commissions and marketing and paid ads and every other marketing activity and effort. And you've acquired 150 new customers that haven't come and bought anything from you yet. Doing a little bit of math, that count can be calculated as just taking the total marketing expenses divided by the total number of new customers. And so we put that math in there, and the CAC, or customer acquisition cost, for this example e-commerce store selling shoes would be about $13.33 per new customer. That means on average, you're spending about $13.33 to acquire a new customer through your marketing efforts during this particular month, for our example. So understanding your CAC really helps in assessing the efficiency and effectiveness of your marketing strategies and allows you to allocate your marketing budget more effectively to acquire customers at a reasonable cost. The next one we're going to talk about is conversion rate. And conversion rate, we're going to assume that we had 1,000 website visitors out of 500 which made a purchase. So how many of those were converted? And conversion rate can really be calculated just by the number of conversions divided by the number of website visitors multiplied by 100. And we plug those values in, and as you can see, the conversion rate for your store would be about 5%. This means that 5% of your website visitors made a purchase during that particular month. Understanding the conversion rate helps assess the effectiveness of your website's design, user experience, and your marketing efforts in converting visitors into customers. Increasing the conversion rate really can lead to higher sales and improved profitability for your e-commerce business. Businesses that are managing physical products, the inventory turnover ratio is a key metric for managing your inventory efficiently. It calculates how quickly inventory is sold and replenished within a specific period. Striking the right balance between inventory levels and sales velocity is essential to minimizing carrying costs and avoiding stockouts. So let's calculate the inventory ratio using the information we have. Based on these, the number of sneakers sold was 100, total boots was 50, number of sandals was 75. We have the cost at 30, 50, and 10 respectively, and we know that our beginning inventory value was $2,000. We had $2,000 worth of boots, sandals, and sneakers all on the shelf at the beginning of the month, and at the end of the month we ended up with inventory value of $3,000 sitting on the shelf in the combined total. So using this data, we first need to figure out what our cost of goods sold for each type of shoe is. For the cost of goods sold for our sneaker line, this is important to do it by category, or in our case we're doing it for sneakers. You just take the number of sneakers sold, multiply that by the cost of the sneakers that cost you as the store owner, and plugging those numbers in, and we get $3,000 is the cost of goods sold for sneakers. Doing the same thing for boots, and we get, plugging in our numbers, we get $2,500 in boots, and then doing that for sandals as well, we get $750 in sandals. After adding them all up, we get $6,250 in cost of goods sold across product categories. Now, the second part of this, in figuring out this inventory ratio, is to figure out what our average inventory is. We take the beginning inventory, add that to the ending inventory, divide it by 2, and we get 2,500. So that would be our average inventory. Let's plug those values into this formula, into inventory ratio formula of total COGS divided by average inventory. We plug those numbers in, and we get a ratio, an inventory turnover ratio of 2.5. Now what this means is that on average, your entire inventory was sold and replaced approximately 2.5 times during that particular period. Tracking this number over multiple periods, time periods, and by product type can really help you strike the right balance between inventory levels and sales velocities, which is essential to minimize carrying costs and avoid any kind of stockouts. The next one is gross profit margin. Gross profit margin reflects the percentage of revenue that translates into profit after deducting the cost of goods sold. So while focusing on sales and revenue growth is essential, prioritizing profitability ensures the long-term sustainability of your e-commerce business. Analyze your cost structure and pricing strategies to improve your gross profit margins over time. So using our example, let's calculate the gross profit margin for our sneaker store. To calculate this, we've just got to subtract cost of goods sold from total revenue to get gross profit, and then multiply that by 100 to get a percentage. So we first need to calculate the gross profit itself, and then we can do a gross profit margin. So we know that we have total revenue of $11,250. Our total cost of goods sold is $650. And so plugging these numbers in, we get $5,000 as our gross profit. Now we take that gross profit and divide that by the total revenue, and after plugging in those numbers, we get 44.44%. This indicates that for every dollar of revenue generated from shoe sales, your store retains about 44 cents as gross profit after accounting for the cost of goods sold. This tells you how much you have to cover the rest of your expenses, your other expenses. So analyzing your cost structure and pricing strategies, it can really improve your gross profit margins over time. Now we're going to move on to net income. While profit margin reflects the percentage of revenue that translates into profit after deducting all expenses, this is important to do, but while focusing on that top line growth is essential, really prioritizing the bottom line and the bottom line profitability ensures the long-term sustainability of your business and helps you analyze your business and the operational efficiency of your business. And we need to analyze that and make adjustments to improve your net income over time. So to calculate net income, it's pretty straightforward. we'll need to deduct all of the operating expenses from our gross profit. Operating expenses typically include things such as wages and rent, utilities, marketing expenses, taxes, and other costs associated with running the business. Using our example, we're going to use these assumptions to calculate our operating expenses. We want to add all these up. We have salaries at $1,000, rent $500, utilities $200, marketing expenses $2,000 like we had before, taxes of $300, and other costs of $200. So we add all of that together and we get $4,200. Now let's calculate the net income. We know that net income is equal to the gross profit minus our total operating expenses. Net income after deducting all the specific operating expenses, for our example, would be $800. This represents the net profit left over after accounting for wages and rents and utilities, marketing expenses, taxes, and everything else. Net income is also known as net profit or the bottom line, and it represents the residual profit after deducting all the expenses from total revenue. In simpler terms, it's the amount of money a company has left over after covering all of its costs. Net income is crucial in any business, including e-commerce's, for several reasons. First, financial performance evaluation. Net income provides a clear indicator of a company's financial performance over a specific period. It reflects how efficiently the business operates and its ability to generate profits from its operations. Number two, business decision making. Net income influences strategic decision making within the company. It helps management determine the allocation of resources, such as reinvesting profits in the business for expansion or paying dividends to owners or reducing debt. And number four is tax obligations. Now, net income is crucial for determining the company and or the owner's tax liabilities. It serves as a basis for calculating income taxes and accurately tracking income over time, which is essential for compliance with tax regulations. In the context of e-commerce businesses, net income holds particular significance due to the unique dynamics of selling online. E-commerce companies often face intense competition from fluctuating market trends and evaluating consumer preferences. Achieving and maintaining a healthy net income is essential for sustaining operations, funding growth initiatives, and remaining competitive in this digital marketplace. Additionally, e-commerce businesses typically have specific operating expenses related to website maintenance, digital marketing, fulfillment, and customer service, making accurate calculations and management of net income crucial for your financial sustainability and success. Remember to analyze your cost structures and your operational efficiency to improve your net income over time. The next metric is return on investment, or ROI. And you can use this in lots of different ways. ROI measures the return generated from investments relative to the costs of those investments. Whether it's marketing campaigns or technology upgrades or expansion initiatives, assessing the ROI of these different things enables you to allocate resources effectively and prioritize investments that yield the highest returns. It calculates the return on investment, or ROI, of our marketing expenses, for example. We use the following formula. We take the net income divided by marketing expenses and multiply the result of those by 100 to give us what we're looking for. So we'll continue with the example we've been using, and we know that our net income is $800 and that total marketing expenses is $2,000. So plugging those numbers into the formula gives us an ROI of 40%. This means that for every dollar spent on marketing, the company earned 40 cents in net income. A positive ROI indicates that the marketing efforts are profitable, generating more revenue than the expenses incurred, and it's a key metric for evaluating the effectiveness and efficiency of marketing campaigns and other initiatives in driving business growth and profitability. Mastering these financial metrics really empowers you as the store owner to make informed decisions to drive growth and confidently navigate the online retail's complexities. By leveraging these metrics as guiding principles, you'll not only optimize your performance, but also cultivate a resilient and thriving e-commerce business. If you have any questions or need assistance with managing your company's finances, don't hesitate to reach out. We're here to help you piece together financial freedom. You can schedule a call by going to jacobcurtiscpa.com/5-strategies-calendar to get started. And remember to follow me, Jacob Curtis, and Curtis Accounting Solutions on Facebook, Instagram, Pinterest, and YouTube. Thanks for watching, and we'll talk to you later.